Have you ever stopped to think about what really happens to your money when you deposit it in the bank? You probably figure it just sits there, right, in a digital vault, waiting for you. But what if I told you that your simple bank account is part of a system so powerful it literally creates money out of thin air? Well, today we're going to pull back the curtain and uncover the hidden world of commercial banking.
You know, for most of us, a bank is basically a high-tech mattress, a secure place to stash our cash. We put money in, we take money out. Seems simple enough, right? A straightforward safekeeping service. But believe me, that is just the tip of the iceberg.
That's right. Commercial banks don't just hold money. They are, for all intents and purposes, licensed to manufacture it. The vast majority of the money flowing through our economy every single day isn't printed by a mint. It's created by banks. And the way they do it is way more fascinating than you might think.
So how does this magic trick actually work? Well, it's not really magic at all. It's all built on two very simple, interlocking jobs that define what a bank even is. And if you can understand these two pillars, you've cracked the code. So here's the official textbook definition. At its core, a commercial bank is just a middleman. It takes money from people who have a little extra, that's us, the depositors, and it gives that money to people who need it, to buy a house or start a new business. And for any financial institution to legally be called a bank, it has to do these two specific things. First, it has to accept deposits that you can get to easily, like with a debit card. And second, it has to be in the business of lending money. If it only does one of these, it's something else, but it's not a bank. Okay, so to perform these two core jobs, banks have a pretty basic toolkit. This is their bread and butter. It all boils down to accepting our deposits and then advancing loans. Let's take a look at each tool. First things first, a bank needs raw materials to work with. And that raw material, it's our money. They need to attract deposits from all of us, because that cash forms the foundation for everything else they do. But, as you'll see, not all deposits are the same.
So here's the basic trade-off we all face. On one side, you have demand deposits. That's your everyday checking account. The money is there whenever you want it, but you earn basically zero interest. On the other side, you have fixed deposits. You agree to lock your money up for a while, and for that, the bank rewards you with a much higher interest rate.
And now for the second part of the toolkit, which is where things get really active. This is where banks put all that deposited money to work. They use that giant pool of funds they've collected to give out loans and advances. And this, my friends, is where they start making their real money. And they've got a whole menu of ways to do this, each one designed for a different need. A business might need a steady line of credit to manage daily costs. You might need a short-term loan for a big purchase. Or maybe you just need the safety net of an overdraft on your account. It's all about getting money into the hands of borrowers.
Okay, so we've got the two functions and the two main tools. But so far, this just sounds like they're moving money from one person to another. So let's get to the main event, the big reveal, the process that turns one little deposit into a huge wave of brand new money.
This is the million-dollar question, isn't it? If I deposit 1,000 rupees and the bank just lends those same 1,000 rupees to somebody else, how is that creating anything? It feels like it should still be the same amount of money in the world. The answer is all down to one very important rule.
And here it is, the secret sauce. It's called the legal reserve ratio, or the LRR. This is a rule from the central bank that says for every single deposit a bank gets, it has to keep a small fraction of it, let's say 20%, as a reserve. It absolutely cannot lend that part out, but it can lend out the rest. And that's the little key that starts this whole incredible engine.
Okay, let's follow the money. So you go and deposit 1,000 rupees. The bank, following the rule, holds on to 200 of those rupees, but it loans out the other 800 to someone we'll call Ram. Ram then uses that 800 rupees to buy something, and the person who sold it to him deposits that 800 into their bank. And bam! Right there! That 800 is now a brand new deposit. Your original 1,000 has just become 1,800 in the system. New money was just created.
And here's the wild part. It doesn't stop there. That new 8,000 rupee deposit? Well, its bank keeps 20% in reserve and loans out the rest. That loan becomes another new deposit somewhere else, and the cycle continues, on and on. This table shows you just how powerful that chain reaction is. An initial deposit of just 10,000 rupees can eventually lead to 50,000 in total deposits across the entire banking system.
This absolutely incredible cascading effect has a name, of course. Economists call it the money multiplier. It's the mechanism that lets the banking system expand the money supply way beyond the actual physical cash sitting in vaults.
And the math behind it is beautifully simple. If you want to know the maximum power of the multiplier, the formula is just 1 divided by the legal reserve ratio. So in our example, the LRR was 20%, or 0.2. 1 divided by 0.2 is 5. That's how our 10,000 rupees was able to multiply itself by 5 to become 50,000.
But for all this fancy math and economics, the entire system, this whole inverted pyramid of money, is resting on one very simple, very human foundation. And this quote gets right to the heart of it. It all comes down to trust. Your faith that the bank will give you your money when you ask for it, and the bank's faith that borrowers will pay back their loans. Without trust, the whole thing grinds to a halt.
Now, creating money is clearly a bank's superpower, right? It's their most important job. But it's definitely not their only job. Over time, modern banks have evolved into these incredible one-stop shops, kind of like a financial Swiss Army knife for all your needs.
I mean, just take a look at this chart. Beyond those primary functions we just talked about, banks handle a ton of other services for us. Their responsibilities go far beyond just being a middleman for deposits and loans.
They act as our personal agent, moving our money around, paying our bills automatically, collecting payments for us. They also provide all these other useful services, like giving us a safe place for our valuables in a locker, helping us exchange currency for a trip, and even helping big companies sell stocks to the public.
Okay, so we've taken the engine apart piece by piece. We've seen how banking works, from a simple deposit all the way up to the magic of the money multiplier. But let's zoom out for a second. Why does all this matter? What's the big deal? Well, the big deal is this. Banks are the heart of a modern economy. By creating all this credit and then aiming it at useful projects, they are literally pumping the financial lifeblood that keeps everything going. They're the ones funding the businesses that hire people, the mortgages that let families buy homes, and the big ideas that lead to innovation.
And that leaves us with one final, pretty important thought. We've seen that banks aren't just passive storage units for money. No, they are powerful, active engines that drive our entire economic world, all thanks to their special ability to create money. This gives them an enormous amount of power and influence. So, the question we should all be asking ourselves is, if banks are the engines, who exactly should be holding the key?